Hey guys, I'm just going to film this video related to the midterm review. Now the teacher did go over this exact question and the solution is posted, but I thought it would be beneficial to simply go through it sort of step by step and show how we're going to build our tax reconciliation and our journal entries out of the values we're given and where the numbers come from. The solution for this is of course posted on my Canvas, but I am going to walk you through the question step by step. So let's jump right in. We're told about a company that's been in business for 4 years. So this would have been their first year of operations. We're given their income and their tax rates, the value of their capital assets, and the amount of depreciation in CCA they took. We're also told about some golf dues that they had in the first 2 years. We're asked to prepare a tax reconciliation, to prepare the journal entries for all 4 years, and then sort of down a bit, we're asked to make a balance sheet and an income statement. And I'm going to walk you through all of those and show you how to source these from the numbers you're given. So a tax reconciliation is really just a review of Chapter 16. It should be fairly simple to you, so I'm just going to go through it quickly. First, I'll enter the values of our income and losses we made each year, the golf dues of $3,000 each year, the depreciation of $9,000 each year, and then the values of CCA. We took $10,000 the first year, $14,000 the second year, $5,000 the third year, and 0 in the fourth year. And this is our tax reconciliation finished. You can see that I do have it set up to automatically calculate the taxes payable. This is just going to multiply the taxable income by the tax rate in that year. And we're not required in the question to come up with the net income or loss, but I have added it here. So now we're asked to prepare our journal entries. And to prepare our journal entries, there are some values that we need to know first. And one of them is the adjustments for temporary differences. So we only have one account here that makes a temporary difference, and in this case, it's capital assets. And I am going to walk you through these, how to make these charts and how to fill in the T account. These values are given in the solution, but I thought it would be useful to see how we would build them and how we would do the deferred tax T account from scratch. I think the explanation will help to understand. So the tax basis, as we're always going to remember, is linked to CCA. So as far as the government is concerned, our capital assets are worth $60,000 minus $10,000, or $50,000. On an accounting basis, we, the accountants, believe these assets are worth $60,000 minus $9,000 of depreciation. And this creates a temporary difference because there was a disparity between how much CCA we took and how much depreciation we took. And in this case, the difference was $1,000. And because this number is negative, that effectively represents income that we didn't pay taxes on, that we will at some point have to pay taxes on in the future. And the amount of deferred tax that we have is 25% of that, because we can see that that was our tax rate in the first year. And you can see that I have this set up to automatically multiply this to save us time, and that each of these deferred tax rates are sort of linked to the tax rate of each year. So 25% of $1,000 is $250, and that is the amount of deferred tax we created when we didn't take the same amount of depreciation in CCA. So think of it this way. We opened our business on January the 1st. Let's just imagine that. It's January 1st, 2001, and we start our business. Over the whole year, we accumulate $10,000 of CCA, and we take $9,000 of depreciation. This creates a temporary difference, which creates the deferred tax liability. This is tax the government's going to come for sooner or later, and we have to pay it. So now, to account for this, because we legally have to, we open this deferred tax T account, and on our closing date, the 31st of December 2001, we effectively make both our first entry and our adjustment for that year. we put a $250 credit balance in this account to symbolize the liability we owe to the government. And this 250 becomes our opening balance in the next period, or the next year in this case. And now we're going to do the entry for year 2. We're going to figure out how much any temporary differences we created in year 2, and any deferred taxes we have in year 2. So we're going to remember that CCA and depreciation accumulate. So now, according to the government, this asset is worth $50,000 minus $14,000. And according to us, it's worth $51,000 minus $9,000. And our temporary difference is equal to our tax basis minus our accounting basis. So we can see here that we've created more deferred taxes. Our temporary difference has added to the amount of deferred taxes we have, and in our case, it's a liability. This is another $6,000 of taxes we didn't pay. Well, income we didn't pay taxes on, in the amount of $1,680. And this is a credit because it's a negative number. So a negative number is a credit or a liability. And it is going to be our ending value in 2002. So now we need to adjust this 250 upwards to 1,680. So this is set up to automatically calculate the adjustments to subtract the opening balance from the deferred tax. But we could calculate this by pressing equals, and we would see we get the exact same number as we minus our beginning balance from our ending balance to get the adjustment we need to make. So now we're going to move on to year 3. Our tax basis is equal to $36,000 minus $5,000. And our accounting basis is equal to $42,000 minus $9,000. So our temporary difference is equal to our tax basis minus our accounting basis. And you can see that even though we took more depreciation than CCA in this year, we still have a negative temporary difference because the differences were so large in the previous years. We haven't caught up and reversed this yet. So we did, however, pay down some of the taxes we owe. We end up with a lower balance this year. So we still do have a liability here, but it's not as bad as it was. In a sense, because we took more depreciation than CCA, we have paid down a portion of the taxes we owe. Effectively, if we look, we've paid down $1,140 worth of those taxes. Our adjustment is going to be a debit this time because the debit will subtract from the credit, and we need to lower the $1,680 down to $540. We can see the adjustment here, but we can also do it in our T account by simply subtracting our ending value from our beginning value to get $1,140. And that's our adjustment in year 3. So finally, we're here in year 4. And in year 4, we don't take any CCA, but we do take $9,000 worth of depreciation. And in this case, our temporary difference is a positive $7,000. So in a sense, this is $7,000 worth of income we pay taxes on that we could have waited to pay taxes on. We've prepaid these taxes, and we've prepaid taxes on $7,000 of income at 30%, or in this case, $2,100. So now our ending balance is a positive number, or an asset, or a debit balance in a deferred tax account. We have $2,100 in a deferred tax account, or $2,100 of taxes we won't have to pay at some point in the future. So now we need to again adjust this upwards. We both need to cancel out our credit balance. Essentially, we need to throw $540 in that hole, and then we need to raise our debit balance up to $2,100. This is again set up to calculate the adjustment. But to do the adjustment, we can also do it just right in the T account by adding these numbers together. Think of this 540 as a negative number in a sense. we're throwing $540 into the hole, so it doesn't count when we're trying to raise the balance. Meaning $540 of this $2,640 goes to plug up this, and the remaining $2,100 raises the debit balance at the end of the year to the value we need. And I hope that sort of makes a logical kind of sense to you, so you can see how we built the deferred tax T account. So now that we're done all of this, we're going to do our journal entries. The first 2 years are actually pretty simple. We've already figured out our income tax payable. In year 1, it's $20,500. And we've already figured out a deferred tax. It's a credit balance of $250. And we can just sum our credits to get our debits because the income tax expense is a plug. So this is equal to 250 plus 20,500 or 20,750. And in year 2, it's really the exact same thing. We have an income tax payable of 21,840. We have a deferred tax deferred tax liability on our CCA. Now remember, we're not entering the ending value. We're entering the adjustment. This journal entry is what adjusts this 250 upwards to 1,680. So we're entering the adjustment for our journal entry. And again, our income tax expense is just a plug. It's the sum of our credits in this case. So here's where things get a little complex. To start with, we can easily see, since the total value of our loss was $296,000, we have an ample loss to cover all of our previous gains. And we can go back up to 3 years, so it's no big deal to go back to. And we're going to be able to recover all of the income tax we paid. So we're going to recover the full amount of income tax we paid. In this case, $20,500 plus $21,840. And we're going to recover $42,340 in income tax. And we need to see now how much loss we have left over to carry forward. And I've sort of set up these cells here to facilitate that. So we had a total loss of $296,000. We had income in year 1 of $82,000. And we had income in year 2 of $78,000. So how much do we have left over after we've covered all our losses? Well, we have our loss minus the first amount covered minus the second amount covered. So we have $136,000 to carry forward into the future. And and we're going to carry it forward at the tax rate that we lost it at. So this is equal to 136,000 times 27%, or 36,720. And that's the amount of deferred taxes we have to carry forward in the future to cover any future gains. Finally, this year, we're going to enter the adjustment for our deferred tax asset to CCA. And this adjustment is what is going to lower that 1,680 down to that 540. And finally, our income tax expense recovery. This is simply a plug of all of our debits in this case. And you can see we get 80,200. So now we're into year 4, and year 4 does want us to make 2 entries. First, we're going to pay the income tax. We're going to make the entry to pay the income tax that we owe. In this case, $29,700. We have a deferred tax CCA, and remember, it's the adjustment. We're adjusting this 540 to the debit balance of $2,100. So we're going to add our adjustment here. We've already done that. And we're going to see what our income tax expense is. In this case, it's going to be equal to $29,700 minus our debits so that we can balance, or $27,060. Now we're going to get money back. And we need to do a few calculations here. But the first thing to note is we are going to get back all of the income tax payable. That part is easy. But now we need to know, how are we going to adjust the loss carry forward debit account? Well, to start with, at the end of 2003, when we lost that money, we carried some of it forward. This would have had a balance in it equal to 36,720, the amount we carried forward. And now we need to know how much we have to carry forward at the end of this year once we've covered the full amount of the $99,000. So effectively, part of this $136,000 is going to cover this $99,000, and we're going to have a new ending value that we're going to have to adjust our entry to. So sort of let me show you how it works. The remaining loss we have at the start of year 4 is $136,000. In year 4, we made $99,000. You can see that right here. At the end of the year, we do have some left. We can just sort of see that we're going to have some left over. So we have $37,000 left to carry forward. And we're going to carry that $37,000 forward at the tax rate we have, 30%. So if we press equals here, that $37,000 is going to be carried forward at 37%. Meaning the balance, the debit balance, or the asset we still have of loss carry forward is now worth $11,100. So we need to make a credit entry here to adjust it downwards to the $11,100. So to figure out what we need to enter in our credits to adjust it downwards, we can just subtract our ending balance from our beginning balance here and see that we need $25,620 as an adjustment. So that's essentially what this is going to be worth. Now, our income tax expense is a plug. It's simply equal to our debits minus our credits so that we can balance. And we're going to get an income tax expense of $4,080. And those are all our journal entries done. That's what we're being asked there. So finally, what we're asked next is to do the balance sheet and the partial income statement for all years. And I'm just going to kind of go through this sort of slowly, just so hopefully it makes sense. So we'll do it 1 year at a time. So in year 1, we have no income tax receivable. We can see clearly in year 1, we had no loss carry forward and no deferred tax asset because our value in year 1 up here was a liability. It was a negative number or a liability. So we had 0 deferred tax asset for CCA and 0 deferred tax asset for loss carry forward. We did have an income tax payable. We had an income tax payable of $2,500. And finally, we had a deferred tax liability. That's what this is. So it was equal to $250. And you can see it here in the credit account, here as a negative, and here as a credit in our deferred tax T account. So that means it's a liability. So let's move on to year 2. In year 2, we also had 0 income tax receivable. We didn't get a refund in year 2, we paid. We didn't have a deferred tax asset in year 2, and we didn't have a deferred tax loss carry forward. We paid income tax in year 2 of $21,840, and we can just link to it up here from our tax reconciliation. And finally, we had a deferred tax liability. Now, it's important to note that even though we use the adjustment here, this is the balance sheet. So what the journal entry does is it adjusts the balance sheet to the correct value. Since this is our balance sheet, we're going to use the ending value that we had at the end of 2002. So we can see that our ending balance here is $1,680. So then we had income tax receivable in year 3. We actually did recover. We did receive we did receive a refund on our income tax in year 3. It's equal to the full value of the income tax we paid in the previous 2 years. We could really source it from anywhere, but it's equal to the full value, so we'll just get it from here, of $42,340. we didn't again have a deferred tax asset in CCA, but we did have a loss carry forward asset. We have that right here. We already calculated it. This is the amount of the loss that we carried forward, 36,720. We had zero income tax payable this year because we had a loss. And finally, our balance, and remember it's our final balance this time, not our adjustment. Our adjustment here brought the 1,680 down to the 540. So our deferred tax liability for CCA is equal to the 540. In year 4, we didn't have any income tax receivable. We did have a deferred tax asset equal to CCA. Because we didn't take any CCA, our deferred tax now does have a debit balance, so it is an asset. And we had a further deferred tax balance in our deferred tax account of $11,000. We had no income tax payable in year 4, and we didn't have any liabilities in our CCA account because it was a debit balance. We had an asset there. So then we're asked to do the income statement, and this is sort of the last part, and I do have it set up to sort of auto-calculate. What current portion means is the current portion is how much income taxes did we pay in that year or recover. So what the current portion you should think of the current portion as is how much income taxes did we pay or recover. So in year 1, we paid $20,500. In year 2, we paid $21,840. In year 3, we recovered that amount. And we're going to enter the recovery as a negative number. So this is equal to negative, open bracket, the full amount that we paid previously. We're going to close the bracket. In year 4, we paid $29,700. In these years, we didn't recover any from loss carry forward. But in this year, we recovered the full amount. So this is simply equal to this amount plus the negative. And finally, the deferred portion is going to essentially represent the sum of our deferred, both our deferred tax and our loss carry forward. And let me just sort of show you how that works. It's the simplest in year 1 and 2. In year 1, it's equal to 250. In year 2, it's equal to this, the 1,430. In year 3, another thing to think of is this is positive when it's a credit and it's negative when it's a debit. So in year 3, this is equal to the negative because these are debits. It's equal to the negative sum of both of our deferred tax accounts. So 1,140 plus 36,720. And this gives us our total here. And finally, in year 4, we have one debit balance for deferred tax and one credit balance for deferred tax. And we're going to sum those together. Essentially, this is going to be equal to 25,620 minus 2,640. Because remember, according to the income statement, a credit balance will be positive and a debit balance will be negative. And this is going to give us 22,980. And that is how you would build this entire question. That's everything about it.